Hi, David Kersten with the Kersten Institute here, welcoming you to another Inside Source broadcast. Today we're going to be talking about the city of Richmond in the Bay Area, which has actually been in the news a lot lately with some new revelations that they're actually teetering on bankruptcy. This is a matter of some debate. Public officials tend to more positively represent the agency's financial condition, whereas if you actually look at what's going on, some of the documentation, which not a lot of folks know about, things tend to be a bit worse than is publicly represented. So we're going to take a quick look at the 2015 CAFR report for the city of Richmond, California. And, I live in the Bay Area, and I've been hearing a lot about Richmond for a number of years being in pretty bad shape. So let's take a look and see what the numbers show. Just for the record, the budget, the agency's actual budget, usually does not contain enough information to really make an assessment. That's more year to year and kind of what the best foot forward the agency likes to put. The CAFR report, Consolidated Annual Financial Report, is required by state law, and it requires a number of things that are a lot more useful to determine the agency's underlying financial condition, particularly over time. So I'll try to keep this as brief as possible. We're going to hit some of the highlights of, when I get under the hood, what I tend to look for and to really assess the underlying financial condition of an agency. So here are some highlights and description. Really, I only look at about 5 or 10% of each of these reports. When you know where to look, it doesn't make sense to read a lot of this text. It's really just boilerplate, and again, sometimes borders on misrepresenting the severity of some of the numbers. So I go straight to the numbers. It's important to see what they're saying about the numbers, but I really take a lot of the text as a grain of salt compared to the actual figures. So City of Richmond's net position, this is as of June 30th, 2015 and 2014, totals negative $141 million. This is in thousands, so you got to add 3 zeros to that. So that is millions of dollars. So from 2014 to 2015, in 1 year, they lost about $350 million in net value, which is concerning. But, I know a lot of that is just from the pension obligations going onto the books in 2015 for the first time. So this is their net worth. Their total assets, $657 billion. Total liabilities, $769 million. So they are negative $141 million, which is actually fairly common in California. Ideally, you'd like to see that number be positive. That's the first thing I look at. And really where that has gone over time is an indicator of if things are getting better or worse. Government activities, net position, this just breaks it down a little bit further, but we're going to jump ahead. I don't want to get into too much of the weeds. I know a lot of these figures are already a bit too much for some folks. Total debt, you see total outstanding debt about $400 million. Okay, we're going to go. Here's some more detail on the liabilities, inflows, but there's really a couple more sections I just want to look at. Total revenues, $140 million. Total expenditures 135. So they actually had a slight $4 million surplus at the end of that fiscal year for the general fund, but total governmental funds actually ran a $4 million deficit. So, they're running a deficit means they're drawing down on funds. Again, you got to look at that over time to have any real context for that. A lot of these statements are a little bit too detailed. I think what's really instructive is to look at their overall revenues over time and how their ability to pay for what their total debt is. And if that debt is increasing at faster rate than their ability to pay, that's where I really see the real red flags. And I know that they've cut their costs and staff by 20%, but they're still having difficulties paying for their ongoing costs and their debt. So let me just get to the right parts of that. Here's some long-term debt obligations, which I always look at in terms of what their total debt is. Their bonded debt, you see here's some pension bonds. Pension bonds alone is $200 million. They're in the red by almost 200 million. So, that's definitely a contributing factor. Long-term debt obligations. Well, ideally, that first chart goes through and actually adds up all these debts. The one thing it doesn't include is the retiree health care, the OPEB debt, other post-employment benefit obligation debt. So that negative 170 million or whatever it is actually needs to be increased by the amount of the OPEB debt. So this is getting to be a little bit too into the weeds, but I'm gonna just jump right to the very end and look at their position over time. I'd go to the very end of the document and back up, and that has a 10-year assessment. So okay, this is still just more. Not really what we're looking for. Okay, 10-year, we're getting close here. Okay, changes in fund balance, governmental funds last 10 years. So really, I'd take this data and would run some more numbers if I wanted a detailed analysis. But first thing I look at here is their excess or deficiency of revenues over expenditures. So here we have 2006. This goes 10 years back. You have they're running a surplus here, and this is governmental funds, which is the majority of their funds. Slight surplus in 07, but then you had the big crash in 08, and this is what really put a lot of agencies on their heels, and most haven't recovered. Some, I shouldn't say most, but some haven't recovered. But here in 2008, they started running significant deficits, and a lot of this was that you had a big drop off in revenues. See, total revenues about 200 million in 2006, and they're declined slightly, but really you have a rapid, a faster increase in the expenditures and revenues, and that's what creates the problem. Here you did have a big drop in 2010 of about 10% or so, but big 20% from 2009. So you have a declining revenue base, which is a real issue, but then you have growing expenditure needs. You see total expenditures, huge increases in these total expenditures. So that's what's creating this huge deficit here. $211 million in 2010. There might have been some sale or some specific accounting thing, but these are all negative, which is a major issue. 2011, let's see, you have really, now we have big declines in the revenue base, even over about 10 years ago. In 2013, 2014, 2015, that says to me they have an eroding tax base, which is a huge issue. You rarely see that to this degree over 10 years, that an agency is actually collecting less revenue than they were 10 years ago, and things do not appear to be improving. Meanwhile, you have expenditures that they've tried to ratchet down, but you have, here's the deficit spending category. So you have roughly $20 million a year deficits that close out a little bit more in 2015. So, that's some major challenges. As far as, the bankruptcy contention, they can probably get by without bankruptcy, but you're really having, it looks like a real challenge to get out from under some of that debt. And, most of that debt's going to be pension, retiree health care, and then some of that bonded debt. So I don't want to get into, an analysis further than that, but, I'd say they're facing some real trouble. I haven't seen a locality in this bad a shape in California in a few years now. Oakland was in some real trouble, apart from some of the bankrupt localities, San Bernardino, Stockton, Vallejo a few years ago. They're in about as bad a shape as I've seen, and I've looked at several hundred of these CAFA reports over the last few years. So I'll leave it at that. If you have any questions, you can email me insidesource@KerstenInstitute.org. Thanks for listening.